Inflation risk is increasing much faster than expected. One of the biggest things that no one is talking about is that Social Security is scheduled to run out of funds by 2032. We can see a situation where there are cuts across the board to all people receiving these benefits. And this would be catastrophic. Literally around 75 million people collect Social Security benefits each month, and it costs the U.S. $1.6 trillion just in 2025. So what's the solution? You first have to understand the federal budget. And here's a breakdown. You can see the 1.6 trillion spent on Social Security, the 988 billion spent on Medicare, and the other expenses spent on Medicaid and other things. And that sums up to mandatory spending of 4.2 trillion. Then you also have discretionary spending. And that has two categories, non-defense and defense. Non-defense, that includes everything like public schools, roads, bridges, airports, courts. And the defense side includes the military budget. Obviously, the Department of Defense, the Pentagon, and overall military expenses that we've been seeing on the news a lot lately. And net interest, this involves the interest we have to pay on debt already issued. And this number is huge. Just think about it. $7 trillion in total outlays for 2025, and almost $1 trillion, or 14%, is paid on debt we already have. So now, since we understand what the government spends, now we have to understand what they receive in revenue. And for 2025, that total revenue was $5.2 trillion, $2.7 trillion from individual income taxes, $1.7 trillion from payroll taxes, and payroll taxes are specifically Social Security taxes and Medicare. Then you also had corporate income taxes, custom duties, and other. So I'm sure something that you saw is that the government spent $7 trillion, but they only brought in $5.2 trillion. So that's a $1.8 trillion deficit. So we're not even close to breaking even. And when thinking about Social Security, it's also a deficit as well. But as we continue our discussion, go ahead and subscribe so you can continue to get valuable insights that look through the noise and the hype. The Social Security revenue received through payroll taxes does not cover the benefit costs paid out to people. And you can see that since 2010, we haven't had a surplus. And by 2025, the deficit is negative $250 billion. So this program is not sustainable as well. And by 2033, the deficit is estimated to reach $400 billion. So what's the solution? Obviously, the U.S. can't cut the non-defense and the defense budget. I mean, this is roads, schools, and the military. So it's probably going to cut one of the biggest buckets, Social Security benefits. But how? So one option is to increase the payroll tax income cap. Right now, that cap is $184,500, meaning that any income above this amount is not taxed for Social Security. It's been proposed to increase this income cap to $400,000. So obviously that would mean more Social Security tax revenues received. And just to break that down a little bit more, the Social Security tax is 12.4% and the Medicare tax is 2.9%. So approximately 15.3% of income up to the 184.5 is paid. Now, if you're a business owner, you have to pay that full 15.3%. If you work for a business, that is split 50-50 between the corporation you work for and yourself, which means individuals pay 6.2% for Social Security and 1.45% for Medicare, and the corporation pays the rest. So back to the 400,000. Would that actually work if that income cap is increased? Well, it could, but you do have multiple ways people can avoid that. And one of those ways is using limited liability corporations or LLCs. For example, the S-Corp. With an S-Corp LLC, a business owner gets the income or revenue paid to the S-Corp, and then they pay themselves as an employee of that S-Corp. Now, when they pay themselves, The government only requires that they are paid a reasonable salary. There's no strict examples for reasonable, but let's, for simplicity's sakes, give this example. Let's say a person have an S-Corp and their total income for the year was $184,500. They pay themselves as an employee $104,500 and they pass through $80,000 to themselves as distribution income. On that $80,000, while they do have to pay income tax, they don't have to pay payroll tax, which is the Social Security and Medicare. So the tax savings is the 15.3% times 80,000. And so they technically save $12,240 in tax savings that year. So you can imagine how this can add up very quickly over the years. And it just doesn't stop there. For Medicare tax in particular, for single tax filers making over $200,000 and couples making over $250,000, they still have to pay the additional 0.9% of Medicare tax on those income levels or higher. So if you're dealing with businesses who are making large amounts of money, especially in the millions or even more, they are very inclined to use these tax structures to cut down on those taxes. Now, the government can try to close those loopholes, and maybe they can, but they will have to deal with pro-business lobbyists who may try to stop that. Now, the other option that is kind of even simpler is just to cut benefits. If you pay out less benefits, then that obviously reduces the amount of the deficit. One easy way is just to increase the retirement age. Instead of 65, it can be 67. Instead of 67, you can raise it to 70. This has been argued as a valid way to do things because people now live a lot longer than they did versus 50 years ago. The other option is having net worth thresholds, meaning that if your net worth reaches a certain level, maybe you get a reduction in your benefits. So for example, if someone is receiving Social Security benefits, but they also have a $2 million stock portfolio that they receive tens of thousands of hundreds of thousands of dividends in, then the government can say, hey, your net worth is too big. We're going to reduce your Social Security benefits and maybe pass on more of that to lower income households. Also, there's been talk of lowering the benefits of people who receive a certain amount of Social Security benefits. And so there are technically over 1 million beneficiaries that receive $50K or more in Social Security benefits each year, or $100K for couples. The government could max out that and say, you can't receive more than $100K or you can't receive more than $50K. So essentially, it would cap the amount of Social Security benefits that can be paid out to anybody. What's going to happen? I'm not really sure. If they try to increase the payroll taxes, then they're going to have to fight the pro-business lobbies. If they try to cut benefits for people who are over a certain age, then obviously a lot of people of their age group may react negatively from a political standpoint. If they try to boost the retirement age, then they could receive some backlash from that as well from people who are getting close to retirement. If they set max payouts for people who are making either $100,000 as a couple or $50,000 as a single for Social Security benefits, then people could actually react by trying to pay lower income and maybe using tax loopholes to reduce the amount of payroll tax they have because they know their Social Security is going to be less. There's not one solution that's going to be perfect for everybody, but each solution could have some backlash or have some unintended consequences. So one thing I'm sure of is that you're not really going to see anybody come out and campaign on benefit cuts, because if they do, basically everybody 50 and up is probably going to vote against them. So this is something that people are going to do at the beginning of their term or when the president is in his last term and he can't be affected anymore because he can't run again for election. They'll push through these cuts. The other big thing people are missing is that there will be long-term inflationary impacts from the Iran conflict. As you know, a lot of the oil and gas infrastructure in the Gulf states and Iran has been damaged. And it's already estimated there's been over $25 billion worth of damage. And this stuff cannot come on in 1 or 2 days or in a couple of weeks. People are expecting months to years. Qatar has said that 17% of its LNG or liquefied natural gas capacity won't be back on for 3 to 5 years. So even if the conflicts end soon, you likely will not see an immediate drop in price back to the pre-war $65 per barrel for oil. The second part is the amount of government spending on this conflict and how's that money going to be paid back. The government not having enough money brought up a $200 billion request for more funds that needed to be approved by Congress. That got a shady reception. Second, the US government wanted to spread the cost of the conflict by inviting other countries in to help them in the conflict, and that didn't really work out either. And third, the administration had even started asking some of the Gulf states to pay the cost of the war. All of this points to the US government potentially not having adequate funds for the war and likely either having to issue more debt or find other ways to fund all of this. And don't forget the upcoming inflation that's going to be spent by the government in order to resupply all those military stockpiles that were spent to get those back to adequate levels. As I talked about in my previous video, when there's huge government spending, the price of parts, labor, production, all of these things push up prices and inflation in the US economy. So what is the market telling us? What type of signals is it giving us about what it expects concerning inflation? One of the best things you can look at is Treasury yields. This is the Treasury yield for the 10-year Treasury note. And since 10-year is long term, and typically when you see interest rates go up, that means inflation expectations are higher over the long term. And you can see just from the bottom of the arrow in March, how it shot up immediately once the Iran conflict started. But you also can see that back in June, it was also high, but trended down until the Iran conflict sparked back up. Now, one thing I will point out that this is very different and we should not expect the same thing. Simply because back in the June conflict, we didn't have the amount of destruction to infrastructure that we have now. The Strait of Hormuz did not get closed. We did not have billions of dollars in damage in oil and gas infrastructure all across the Middle East. So this is a very, very different situation versus June last year. Next, the Fed is telling us that there's an upside risk of inflation and actually signaled to the market recently that they could be looking at increasing rates potentially in the future, not lowering rates. The Fed chair also made the comment that he wants to see the effects from tariffs reduce inflation before he even looks at the oil shock that is happening right now in increasing prices across the board. Everything points to higher inflation. Protect yourself and your portfolio. The time to act is now. Do not wait. Whether it's Bitcoin, whether it's gold, whether it's other assets, you need to have those things in your portfolio that will protect you from the inflation that is definitely coming over the mid to even long term. And remember, focus on the fundamentals. Do not panic sell. Look at the situation rationally, do the research, and make the best moves for your portfolio. And that's what's the angle. If you enjoyed this video, believe it has some valuable insights, hit the subscribe button, turn on those notifications, and I'll see you next time.